Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. In this video, we're going to be talking about the second wave to the downside that's likely making its way for the markets. There are a few potential catalysts for this downside that we're going to be touching on today. The first of which is Q2 earnings season, which officially kicks off tomorrow. We'll go over a few names that are reporting earnings over the course of this week and why these hold importance for the markets overall. The next of which being good old scalding hot inflation, which is no new news, but we do have some CPI data that's coming out on Wednesday, which could give an insight as to whether or not inflation is finally starting to cool down or whether it continues to heat up, which most people are expecting. But I'll talk you guys through my thoughts on inflation. And lastly, the dollar, the US dollar, is going parabolic right now, you guys. We will be taking a look at the charts of the DXY, which is the US dollar currency index. This is the US dollar weighted against a basket of other international fiat currencies, pretty much just showing the global strength of the US dollar. And as you guys can see, we are going ballistic right now. We are in breakout mode, and we're actually seeing the strongest US dollar that we've seen in over 20 years since way back in 2002, which is crazy. Okay, so let's quickly go over each of the articles, each of the talking points that I want to go over with you guys today, and then we'll dive into each one individually. All right, first up, good old Michael Burry, Mr. Big Short himself. So CNBC Pro, the Big Short investor, Michael Burry thinks financial markets rout is only halfway through. So we'll go over this, go over a tweet that he recently released talking about why he also thinks, I should say, there is a second wave to the downside on the horizon, and this does primarily play into earnings. So we'll use this to segue into the second article, going over just a few analyst thoughts on this Q2 earnings season, along with, as I just mentioned, the companies that are slated to report over the course of this week and why those hold significance. I'll just give you guys my general thoughts on the companies that are reporting, okay? So after we cover earnings, once again, White House foresees June inflation reading is highly elevated. Biden press secretary says CPI figures already out of date. Gasoline, food prices continue to heighten inflation in the US. Okay, so again, you guys, inflation been scalding hot. Will it ease up? We'll see. So we'll cover this article, and then I'll give you guys my general thoughts on inflation and the impact, just kind of the game theory play here, you guys. I'm going to be talking a lot about the psychological aspects of what are happening in the market right now, at least from my perspective. And of course, over the course of this, because this is a trading focused channel, I want to talk to you guys about how I'm personally, just the general principles that I'm applying to my strategy as we go through these very emotional, very uncertain, and hyper volatile times. Okay, so I will definitely integrate some trading talk into this video too. Don't worry. And then lastly, once again, take a look at the DXY on the charts. This is the monthly candle. So again, when you're zooming out 20 years, you got to really zoom out. But we will zoom in a little bit here. I'll talk to you guys about what I'm thinking from a technical perspective on the DXY, and then we'll close out the video taking a look at the good old S&P 500 or SPY, and just because it pretty much sums up the US equity markets in one chart, better than any other chart. Okay, so that is the video, you guys. Before we dive into it, please give the video a like if you go on to gain value from it today. Subscribe to the channel if you're new around here, and let me know in the comments down below. Do you think a second wave is coming? Or do you think the markets can escape this? Do you think some relief is coming? And I personally believe there is some silver lining here. I do think that there is some hope for certain areas of the stock market, of just the markets in general, which I will be talking about also over the course of this video. Okay, but before we dive into Mr. Big Short, I do want to read the macro newsletter that I sent out. This is about a week old now, but the same exact principles apply, you guys. And this has been something in the case that we do see the second wave down, catalyzed by earnings season, everything that's kind of kicking off this week. Again, most investors should have been aware of pretty much everything that's going on this week. So today, at the time of recording, the markets were a little bit funky. We saw a massive sell-off to kick off the new trading week. It's Monday the 11th. And considering we came off of such a hot streak, so last week, 4th of July week, was actually, or pre-4th of July week, or yeah, post-4th of July week, 4-day trading week. That was actually the longest streak of green that the NASDAQ and S&P have seen all 2022. So I do still think there's some potential for upside in the short term, but again, with all of these fundamentals at play with Q2 earnings season coming up, the second wave down it seemed inevitable. It's really more a matter of when, not if. So do want to read this for you guys. All of the underlying fundamental principles apply. But yeah, let's just go over this and then we'll dive into the meat of the video. Okay, so the higher you climb, the harder you fall, especially when the climb was assisted by the Fed, and now the fall is being accelerated by that same Fed. I'll continue to say this. We need to fight with the Fed. So we get you guys liquidity injections out the wazoo during the lockdowns during COVID, literally making it so the markets couldn't fall. Now they're on the exact opposite side of the spectrum. They're doing their best to tamper down the economy, to tamper down the markets, and they're pulling liquidity out of the markets instead of injecting it in. Okay, so it's very important to understand that. On top of the intervention from the Federal Reserve, the economic outlook remains bleak due to a strengthening dollar and scalding hot inflation, which will inevitably be taking a toll on earnings growth. I believe that we can begin to recover in the fall-winter months, and I do think that a 2023 could be a strong one. But for the moment, I feel that it's irrational not to believe that further downside will ensue, considering there's a flood of Q2 earnings on the horizon following such a weak and fear-ridden consumer quarter. Okay, so again, you guys, as of right now, I guess if you looked at the headline, if you're looking at the headlines right now, this is, no new thought. But again, I wrote this. This was actually before July, so this was on June 30th. So this was almost 2 weeks ago now that I wrote this. And again, you guys, there's so much emotion, there's so much speculation, there's so much volatility in the markets, which is again why I do think that there is the possibility for another spurt of short-term upside prior to this real second wave of elongated downside. But again, you guys, when you're just from a basic fundamental perspective, it's very, very difficult to be bullish from a medium-term time horizon given this flood of Q2 earnings that are on the horizon. Okay, so money has been drying up in the summer heat, but thankfully Waves Cap has been doing a good job at preserving our buying power for the most part. I'm proud of how we've navigated the portfolio. And again, you guys, it's been a rough year, but you just got to do your best to do your best. And thankfully, we have been doing pretty well so far. So let's hope we can continue to have a strong summer and strengthen up our balance sheets as much as possible for the months ahead. If you guys want to know how I'm personally trading on a day-to-day basis, if you guys want to join Waves Capital, not just the YouTube, but if you guys want to join the trading game, if you guys are interested in getting involved, just taking the step to the next level, check out the first link down in the description box below. That is going to be $15 a month or $40 for every 3 months. That's completely up to you. But with that, you gain access to a complete breakdown of my entire personal portfolio, which I do update every single trading day during market hours, along with the 3 email newsletters that I release every single trading day. Okay, the first of which is my trade alert newsletter. Let you guys know what trades I'm making in as real time as it can get and why I'm making those trades, rationalizing my trades for you guys. Then comes the macro newsletter after that. Similar to this right here, talk about the macro, take a look at fear and greed, take a look at a lot of psychological and macroeconomic indicators, of course, that I believe are dictating the market that day. And lastly is the price targets newsletter, where I include 4 to 5 charts every day that are most relevant to Waves Capital and does some real-time price targets for some of the trades in the portfolio. Okay, once again, first link down in the description box below. Give it a shot. You can always unsubscribe, but I trust you will not regret it, and I look forward to seeing you guys in there. So, appreciate it if you check it out. If not, though, no worries at all. Let's get into the rest of the video. Okay, so, Burry, Mr. Big Short. The Big Short investor Michael Burry, known for calling the subprime mortgage crisis, warned investors that 2022's market turmoil is only half finished. Burry, who runs hedge fund Scion Asset Management, said the losses in stocks in the first half of the year have mostly been a result of multiple compression. He said corporations will see an earnings decline next, weighing further on asset prices. So this is his tweet right here. Adjusted for inflation, 2022 first half S&P 500 down 25 to 26%, and NASDAQ down 34 to 35%, Bitcoin down 65%. That was multiple compression. Next up is earnings compression. So maybe we're halfway there. Okay, you guys, so multiple compression, of course, the multiple on fair value of earnings. A lot of times you use PE to dictate that multiple, price to earnings ratio. And right now, S&P 500, growth stocks specifically have had their multiples absolutely compressed and maybe overdone in certain situations. I do think a lot of growth stocks are overly beaten down. I still believe that, and I do still believe that there are some amazing opportunities out there. And there are some growth stocks that I'm very bullish on from both a fundamental and technical perspective. Again, you want to know what trades I'm making, the specific calls I have in play right now. First link down below. But again, you guys, I do think there are opportunities out there, particularly in small caps and growth stocks, if you know how to pick them. If you're picking the right stocks, again, like Roblox, you guys, has been an amazing performer since we began covering it a month or so ago. So plays like Roblox, plays like Unity, even like ARK Innovation at these levels, I do think do hold a lot of potential from a value perspective. But I am personally very hesitant still on mega caps, on the S&P, on the indices, just because Tesla's a great example. And if you guys are part of the newsletter, you would Waves Capital, you're part of the portfolio and newsletter group, you would know that Tesla puts have done us pretty good lately. So I do still have a lot of hesitance around large caps and mega cap stocks. And as always, you guys, my money's where my mouth is with that. But again, you guys, this is a stock picker's market, and it's really about trying your best and doing as much due diligence as possible to find those winners in a bloody market. Okay, so again, you guys, Burry, he is kind of a perma bear, as some would describe him to be, but the guy's been right before, and he has a pretty decent track record when it comes to being a bear. But again, broken clock is right twice a day. Let me know down below if you agree with what Mr. Big Short himself is saying. Okay, so let's take a look at some analyst words on earnings that are coming up this week, as well as those specific earnings. Okay, so in terms of S&P earnings, for instance, we think we're already moving towards an earnings recession. Marathon Asset Management's Bruce Richards said on Monday's CNBC closing bell. Companies are getting squeezed at all sides. They're getting squeezed on the cost of goods and the wages and all things to go into input from our manufacturing goals or services. And on the other end, we think revenues are starting to flatten before turning down at a time when interest cost is going up. That's a lot of downgrades, a lot of potential defaults coming from the system as a result of higher charges. On the earnings front, traders will pour through several major corporate reports this week. On Tuesday, PepsiCo is set to report earnings before the market opens. Other companies due to report include Delta Airlines on Wednesday and JP Morgan Chase, Morgan Stanley, Wells Fargo, and Citigroup on Wednesday. So PepsiCo is going to be interesting. And this is happening probably as many of you guys may be watching this. Pepsi may have already announced earnings. So Pepsi, obviously about as Dow Jones as get, about as legacy a company as it gets. I mean, Pepsi, Coke are just U.S. icons, U.S. pinnacles of industry. So Pepsi's performance, I do think will display a pretty good general gauge of how much people are consuming at the very base level. Again, food and drinks, just the basic staples. And it'll be interesting to see how much inflationary pressures from just all the geopolitical turmoil that's going on right now, how much that'll impact Pepsi. And again, that's pretty much the most consumer-facing ground level company ever. So that will really set the tone for the markets moving over the duration of the week. Next is going to be Delta Airlines. I'm sure you're all hearing about all the travel that's going on, all the flight cancellations. And you'd think that means that Delta's crushing it, right? Delta on fire. If I mean, these guys are getting so many tickets booked, or like so many flights booked, that they can't even keep up, which may come off as a good thing, but that speaks to kind of some underlying fundamental troubles within the business, employment issues, just staffing issues, and also corporate kind of higher up calling the shots issues as well. So Delta is really a toss-up. I'm sure a lot of you guys have heard this as well, but there has been a shift of consumer spending from goods, like whether you're gonna, again, just go to the grocery store, go to Target or something, and buy whatever, just kind of splurge there. There's been a massive shift from consumer-facing services. Again, like Pepsi's not really a good example of that, because Pepsi is food and drink, kind of the staples. But when it comes to what people are spending, kind of just the splurgies, the more splurgish spending, from that to service-based spending and hospitality spending. So Delta, I do actually have faith in. Aside from what I just said, I do think that they do have some, for sure, some logistical issues that they're dealing with right now. But I also think that Again, a lot of consumer spending is now being focused towards service businesses and travel. And again, living in Hawaii, I can speak anecdotally to the fact that there are way more tourists here than there typically are. Definitely that there have been over the past couple of years, obviously. So Delta, there is kind of a silver lining there as well. I actually do think that both of these companies could not disappoint as many analysts are expecting, because pretty much every headline out there are analysts and institutions being bearish on earnings. So I will say that I do think if these earnings reports aren't bad, I don't think they need to be good, but in the case that they're not bad, I do think that will be good news for the markets, okay? So, lastly, the banks, of course, come Wednesday, Thursday, Friday, JP Morgan Chase, Morgan Stanley, Wells Fargo, Citigroup, the pillars of the U.S. financial markets, pretty much the banks, are going to be reporting earnings, and that will just show the general health of the underlying economy. So, pray to God that the banks report decent earnings. It will be very interesting to see. I'm just going to assume, I made this argument for SoFi many times. The reason I like SoFi as a stock is because right now there is somewhat of a consumer credit bubble forming, because people are running out of money at a rapid pace. Again, there's no more helicopter money. There's no more stimmy checks. At the same time, inflation is hotter than ever. The cost of just general living is going up. The markets have crashed. Everyone's lost a lot of their spending power and a lot of any money that they may have made during the pandemic. So when people are running out of money, it's not necessarily that they want to stop spending the way they have been spending when they're used to having more money. It's that they take out lines of credit. So when people are taking out lines of credit, when you're paying high levels of interest on that credit, that is good news for banks. Okay, the more lines of credit a bank's issuing, ultimately the better the underlying business of the bank is. Now, maybe we go into a credit default issue, which I'm not going to get into right now, which is very, very scary. But as of right now, when people are taking out lines of credit, that could be good news for banks, and that's also a silver lining right there. So I remain cautiously optimistic going into earnings, and time will tell. And that's how I feel about a lot of this, you guys. Ultimately, time will tell. There's a lot of factors at play right now that you think are priced in, but evidently the market's all slap you in the face and say they're not priced in. So once again, time will tell. Keep you guys posted, and do my best to post 2 to 3 videos per week now, just because it's summer, slowing down a little bit. Good times will be back as always, you guys. But right now, we're just taking it easy. But of course, once again, the newsletters and the portfolio updated every single trading day. So let's move on to inflation. So White House foresees June inflation reading as highly elevated. I already read through these guys. Let's just read through some of these paragraphs here. The White House expects June's consumer price index figures to be highly elevated as Americans grappled with substantial increases in the cost of gasoline and food, but said the reading was already out of date because of falling energy prices. Quote, gas and food prices continue to be heavily impacted by the war in Ukraine, Press Secretary Karine Jean-Pierre said Monday, adding that the report to be released Wednesday was backwards looking. Such a gnarly alfalfa here. Sorry about that. So, economists surveyed by Bloomberg expect the report to show consumer prices rose 8.8% in June from a year earlier, which would be a fresh 40-year high following an 8.6% reading in May. But Jean-Pierre downplayed the headline number, pointing out that prices at the pump had fallen since the reading. Quote, June CPI data is already out of date because energy prices have come down substantially this month and are expected to fall further. So, this is important, you guys, and this shows what this Jean-Pierre is saying here is that pretty much things are moving faster than a lot of the data can compute. And the CPI data, honestly, you guys, if you actually look at a lot of the figures and the way, I'm not going to get into the intricacies of how they're measuring this data specifically, but I feel like this has never been super accurate. And a lot of people that I respect in the spaces have making a lot of great breakdowns of why this specific CPI number is inaccurate. And even if you're just kind of like anecdotally speaking, like when you go to the store, when you go to buy a chicken breast, when you go to buy a gallon of milk, how much more expensive this thing is? Do you think it's 8.8% year over year? No, it's probably a whole lot more than that. It's probably more like 12, 13, 14, 15%, right? So anecdotally, this doesn't really make sense. In my opinion, I don't know why they wouldn't just make it lower, because it's kind of a fabricated number anyway. So just say it's lower, just ease the tension in the air. Hey, maybe include the first week of July, because again, things are moving so fast. Just in the past week alone, the prices of gas have the prices of a gallon of gasoline nationwide have finally started to ease up. So, yeah, in my opinion, if I was the government, I would just bump the number down a little bit, regardless of the reading, because I feel like it's kind of it's pretty damn speculative anyway. But this CPI data, regardless of what they choose to do here, is extremely important and will inevitably dictate the near term of the markets. So in the case that considering 8.8 is the analyst's average estimate, the Dow Jones analyst average, in the case that it's any lower than that, if we're at 8.6, 8.5, like if we're lower than 8.6 for sure, if it shows that we have plateaued and we are finally slowing down, that is very, very good news for the markets. And that's what the markets would love to see. Okay. But if we're at 9.1, if we break 9 at all, that will be very bad news for the markets. And that will just be yet, once again, another catalyst that is going to initiate that second wave down for the markets. Okay. So right now, again, the underlying theme of this video, this goes for inflation. This goes for earnings. Not really the dollar, I guess, but inflation and earnings. We just want not terrible news. It doesn't need to be great news. It doesn't need to be good news, but we just need not bad news. Okay. So that's June inflation. Let's close out the video by taking a look at the DXY, which is still just climbing to new highs. Look at these freaking candles on absolute fire. And again, you guys, the last time the DXY, the US dollar currency index, has seen 108 plus. We're at 108.30 right now, you guys. That's insane. So the last time we saw this level was back here in October of 2002. So almost 20 years. Almost 20 years since we've seen a level this high. And again, you guys, this just speaks to the power of the dollar right now and why it's so important, as I said in the newsletter, why it's so critical and such a blessing to be preserving your buying power. And again, you guys, like, I'm not saying that it's been the most lucrative year for Waves Cap, but it could have been much worse, and I am thankful for how well we have been preserving our buying power, because ultimately that's what matters from a long-term perspective. Just, again, trading, I am objectively a riskier trader, but at the same time, you need to preserve your buying power. You need to keep enough liquid on deck to be able to deploy during the times like these for the long term, because ultimately that's, as long as you don't get cleaned, you're good, and you're still in the game. You just got to stay in the game, right? So, again, you guys, the dollar is stronger than ever. Dollar goes further than ever, and that's just a matter of not just inflation within the U.S., but inflation around the entire globe. Like, yeah, it's crazy how many second and third order effects this war in Ukraine is having on, especially more impoverished areas like third world countries. This is going to be really bad. So, again, thankful that the U.S. dollar is the global reserve currency. It's funny, like during Bitcoin bull runs and stuff, a lot of people can talk trash on the dollar. I've never felt that way. The U.S. dollar is and will, as long as you believe. If you're long the USA, which I know, again, can be kind of tough, but if you're long the USA, which I am, you should be long the U.S. dollar. This is a global reserve currency, and yeah, it is stronger than it's been in 2 decades, which is insane. So let's move in a little bit here. Go to the 4 hour. We can actually go to the daily, and then we'll jump into the SPY to close out the video. But the DXY, in the past, let's see. And this is staggering for the US dollar index, you guys. So in the past year, the dollar's to a price range from June of 2021 to where we're at now in July of 2020. The dollar has seen a 20% price gain, which again doesn't seem like a lot, especially when we're talking about growth stocks all the time. But as far as the DXY is concerned, that is staggering. And that speaks to the craziness that's going on across the globe. Because again, the DXY is the US dollar relative to a basket of other international fiat currencies. Okay, so dollar absolute strength. I think just today, the dollar has gained a 1-to-1 peg with the euro, which hasn't happened. I don't know when the last time that's happened was, if ever. So that's crazy, you guys. But again, dollar, proud to be an American, I guess. Anyway, dollar is currently in breakout mode. From a technical perspective, I do think that we do need to come down at some point just to retest this previous line of resistance as new support, which is this white line right here. When that happens is the question. Right now, there's the momentum obviously favors the bulls. The macros favor the bulls, and again, you guys, just unfortunately, everything that's happening right now favors a stronger dollar. So if you have dollars, if you've been taking profits, congratulations. yeah, the dollar right now is showing no signs of slowing down. I do think at some point, once again, we will come down and retest this area. But the dollar is a very macro asset, and it could take a very, very long time. So it's really a matter of when on this one. But right now, the dollar is showing no signs of slowing down. Okay, so it's important, you guys. This is a very, very important chart for you guys to keep an eye on if you're trading, if you're an investor, because ultimately the price of the dollar, the stronger the dollar is, the weaker pretty much every asset that trades against the dollar is going to be. And because the dollar is the global reserve currency, it's pretty much every asset, okay, especially the US stock market. Okay, so that's the DXY. Let's close out with the SPY and call it a day. So the S&P 500 is in a very, very obvious downtrend from the high we saw earlier this year. When it comes to my macro downside targets for the S&P, I think it's very, very likely that the S&P ultimately comes down here to test this very, very long-term line of both support and resistance, like just a historical floor for the S&P dating back over 4 years now. So this is the initial touch point here dates all the way back to January of 2018, right? So touch point here, touch point, acted as significant resistance, broke out, came back down. You can just see multiple more touch points here. I do think that this trend line will come into play at some point, the cyan line, okay? And I also think that it is far more likely than not at some point in the future, and if there is going to be a time for this to happen, it's going to be this Q2 earnings season, that the S&P ultimately reverts to the mean and comes down here to revisit the initial high prior to the pandemic crash that we saw back in February of 2020. So that would take us down to about 340 from current levels at like 385. That would translate to a further 12% correction from current levels. And again, this could very well come over the course of this earnings season. But short term, I do think there's some silver lining. From a short term perspective, the SPY still hasn't tested the current line of resistance right here. So boom, touch point here, other touch points right here. First touch point late April, next touch points early June, creating the current line of resistance on this downtrend. I personally think that and again, given kind of my cautious optimism around the earnings that are coming up, I do think it's possible that we see some short-term upside. If we see it by the end of this trading week, July 15th, that would take us up just over 2%. But I do think that given the fact that we are kind of seeing somewhat of a reversal, a potential series of higher highs and higher lows on the short term since the bottom we saw in mid-June, almost a month ago now, high, low, could be on our way to a higher high. But again, the fate of this week, earnings, the CPI data are going to heavily impact this. So in the case that, again, we get some not bad news, I do think it's possible for the SPY to at least come up here and test this resistance. I do think a breakout is possible. And but in the case that we get further bad news, I do think that second wave down is coming a lot sooner than later. And my initial target for the S&P, once again, is the official reversion to the mean, or the revisit of the initial high, the prior all-time high, our previous all-time high prior to that COVID correction, the COVID crash that we saw. Okay, so Tom will tell you guys again, if you want to know how I'm navigating this crazy environment, how I'm operating my personal portfolio, the Waves Cap portfolio on a day-to-day basis, that's going to be the first link down below. I look forward to seeing you guys inside, and I also look forward to seeing you guys downstairs in the comments to talk some shop. Get you guys, you have a thought, please don't hesitate to share it down below, and I look forward to again, chopping it up and talking shop with you guys in the comments. So I'll see you down there. Until next time, always remember, take action, make waves. Peace.